Hey, good morning, everybody. Listen, OPEC put out a report this week, so let's dive inside and see what OPEC thinks about the oil markets, which is very, very critical, especially at this time of year. So we're going to step through that. The oil price or OPEC reference basket declined by 5.53 cents or a 6.2% drop. Oil has been on a downtrend, and that downtrend has really impacted the market on WTI and Brent. So we did go down quite a bit more with the OPEC meeting because they are going to be unwinding some of the cuts in the fourth quarter. However, they did talk about extending some of the cuts into 2025. So it's kind of a nuanced announcement that came on June 2nd. So when we look at the global economic output, this is going to be critical. Uh, OPEC projects a 2.8% in 2024 and a 2.9% in 2025. And most of what is uplifting the percentage growth is China and India. Most of the advanced countries in the West are supposed to have very modest to no growth. So there are conflicting signals out there because there are signals that is weakening demand in China. India is humming along, but there's also strength coming from the US, and that is really changing up some of this model. But if this projection holds true, then I think that OPEC's projection of a 2.2 million barrel a day increase in demand is going to be in play. So IEA, EIA, did I say that right? EIA, IEA, they are projecting about a 1.1 to 1.4 million barrel a day increase for 2024. Most of these projections are all for the second half of the year. So we're really in the show me time for the oil markets. So now let's take a look at the supply growth. Outside of the Declaration of Cooperation or DOC countries, there is expected to be 1.2 million barrels a day of supply growth. And the key contributors are US, Canada, Brazil, Norway. This is OPEC's positioning and reporting. US has stalled out at 13.1 million barrels a day. Canada has been doing some drilling. However, their results have really not added that much to the equation. Brazil, Norway, they have added some. I think we're going to fall short of this forecast, which is actually very supportive for crude prices. So refinery margins, they've been facing kind of a decline or a downward trajectory, and a lot of that has to do with the crack spread. The crack spread has contracted, I think, 20+% over the last month. So there is overall gasoline market weakness, diesel market weakness, and that is impacting margins because the barrel of a crude oil has stayed elevated while these prices have come down, so that the products that are produced on the other side of the refinery are really squeezing those margins. So on the tanker market trends, VLCC and Aframax freight rates are showing improvement, and clean tanker rates are showing an increase. So on the trade dynamics, the U.S. crude imports have reached a 6-month high. So this is one of the indications that we talked about. This is one of the indications that we are actually showing a lot more economic strength than people expect. Now, conversely, we are exporting a lot, so we're increasing our imports, but we're also exporting more. Now, that's not because of supply growth, it's because of a disposition in that we're importing barrels that make a better economic return and exporting barrels that make less of an economic return. So Asia is showing a very large crude appetite, and they're showing strong oil import figures. However, there's speculation and some data that supports increase in storage in China, which may mean some slowing for that growth engine. So some of the stock movements, OECD increased slightly by 16.6 million barrels. However, stocks remain below the 5-year average by 154 million barrels. Now, that's pretty significant. We have a crude supply and demand globally of 100 million barrels. 154 is not an insignificant amount. Now, you could actually draw a conclusion there that because of higher interest rates, we are actually staying lower on the stocks because it's more expensive to hold that in a storage or stock equation because interest rates are higher. So the supply and demand balance. So this is very fascinating to me. So the crude demand for Declaration of Cooperation or DOC countries is sitting at 43 million barrels a day, and demand for DOC in 2025 is 43.9 million barrels a day. They are currently, because of the curtailments, only producing 40.9 million barrels a day. So there is a supply demand disconnect that is happening. Now, outside of the DOC countries is really filling some of the gap right now, but I expect those dynamics to really change in Q4. So the conclusion and outlook, the oil market looks stable. We've seemed to have stabilized after the OPEC Plus announcement on June 2nd, and we're sitting in a range. So here's one thing that I would like to leave you with is stay on top of this. If your business depends on the prices of crude oil, natural gas, refined products, natural gas liquids, you owe it to yourself to research various sources for information such as the EIA, IEA, OPEC in various states such as Texas, New Mexico, Oklahoma, Louisiana, West Virginia, Ohio, Pennsylvania, and so many more. So you could ignore these and only focus on the technicals of the market. I think that's a little misguided. Or you could come join our service. There's some information down below. Rogue Edge, we put all of this data on supply, demand, imports, exports, storage, stocks, and so much more into a package that is only $89 a month. So if you are spending more than an hour a week or even an hour a month on looking for data, you're wasting time and money. Come join our service, and we'd be happy to have you and have you join our community. So I just wanted to put this out there. Hope you're doing great. Hope you have a fantastic day, and thanks so much for listening in.